Have you ever been told you make too much money to contribute to a Roth IRA? If so, today's episode is for you. The good news is that many high income earners may still have a legal way to get money into a Roth IRA through a strategy known as a backdoor Roth IRA. The strategy involves making a non-deductible contribution to a traditional IRA and then converting those assets to a Roth IRA. Today, I'm going to explain how it works, who it may be appropriate for, and one of the biggest tax traps people need to understand before moving forward. What is a backdoor Roth IRA? A backdoor Roth IRA is not a special type of account. It's simply a process that typically involves two steps. First, making a non-deductible contribution to a traditional IRA. Second, converting those assets to a Roth IRA. The reason people use this strategy is because direct Roth IRA contributions may be limited or unavailable at certain income levels, while Roth conversions themselves are generally not subject to income limits. Why do people like Roth IRAs or backdoor Roth IRAs? Many investors are attracted to Roth IRAs because qualified withdrawals can be federally tax-free, assuming IRS requirements are met. That means future growth and qualified distributions may be received without additional federal income tax, which can be especially appealing for those who expect higher tax rates in retirement or simply want greater tax diversification and flexibility. However, whether a Roth strategy is appropriate depends on your individual circumstances, goals, and tax situation. Here's a simplified example of how the process typically works. Suppose a high-income professional wants to add money to a Roth IRA but exceeds the income limits for a direct Roth contribution. They may contribute after-tax dollars to a traditional IRA, elect not to take a tax deduction for tax contribution, convert those funds to a Roth IRA. In some cases, if little or no investment gain occurs before the conversion, the tax impact may be minimal. But, and this is important, that is not always the case. The biggest tax trap, the pro-rata rule. You need to be aware of it. This is where many investors get surprised. If you have existing pre-tax money in traditional IRAs, SEP IRAs, or simple IRAs, the IRS generally looks at all those IRA balances together when determining the taxable portion of a Roth conversion. This is commonly known as the pro-rata rule. In other words, you generally cannot simply choose to convert only the after-tax dollars. A portion of the conversion may be taxable based on the ratio of pre-tax and after-tax assets across your IRA accounts. For some investors, this can create an unexpected tax bill, which is really annoying when you're doing it back to a Roth IRA. That's why tax planning is a critical part of evaluating whether a backdoor Roth IRA strategy makes sense for you. Who should look more closely at this? A backdoor Roth IRA is often discussed by professionals with higher income, business owners, individuals who exceed direct Roth contribution limits because of their income, investors looking to build additional tax-free retirement assets. But just because someone is eligible for the strategy does not necessarily mean it's the right move. Factors such as current tax brackets, existing IRA balances, future retirement income, and overall financial goals should all be evaluated. Key takeaway: the backdoor Roth IRA can be a valuable planning strategy for some high-income investors. At its core, it involves making a non-deductible traditional IRA contribution and then converting those assets to a Roth IRA. However, the pro rata rule and potential tax consequences make it important to understand the details before implementing the strategy. I'm Drew Erickson, and this has been Money Not Math episode 190. Thank you for your time. If you'd like help determining whether a backdoor Roth IRA fits into your overall retirement strategy, reach out to our team. I'd be happy to help. Thanks for watching, and we'll see you next time. Thanks. Bye. This video is for educational informational purposes only and should not be construed as tax, legal, or investment advice. Conversion decisions can have significant tax consequences. Always consult a qualified tax professional and financial advisor regarding your specific situation before taking action. Investments involve risk, and past performance does not guarantee future results.